Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, November 6th at 10 a.m. in New York. So let's get after it. With many stocks down more than 20% from the July highs, a dynamic punctuated by tax loss selling from institutional managers at the end of October, equity markets were primed for some kind of a bounce. However, last week's rally in equities was the largest that we've seen all year, and it was led by many of the year-to-date laggards. Furthermore, both market cap and equal weight versions of the S&P 500 index were up 5.9% as breadth showed its first signs of life since June. In our view, this move in equities was more about the strong rally in bonds than anything else. After an historic rise this past quarter, 10-year Treasury yields reached an attractive level of 5% near the end of last month. Perhaps even more attractive for investors to ignore was that real 10-year yields were at 2.5%. One factor driving bond yields lower last week was the Treasury's announcement of its planned longer-term securities issuance that was below expectations. We also attribute the move to the weaker-than-expected economic data releases last week. More specifically, manufacturing and services purchasing manager surveys fell by much more than expected. The labor market data also showed further signs of cooling. Specifically, continuing jobless claims are now up more than 35% from the cycle trough, and the unemployment rate is now up 0.5% from the lows. Both of these are important thresholds in past labor cycles. Finally, revisions to prior non-farm payroll data have consistently been negative this year, while the household labor survey indicated we lost 348,000 jobs last month. Given the absolute level of yields and the slowing growth and inflation backdrop, bonds may finally be attracting larger asset owners and allocators. Meanwhile, earnings revision breadth remains well into negative territory, with the big growth stocks' earnings results providing only modest stability to this important leading indicator. This year's earnings recession continues to play out, particularly at the stock level. This is one reason why broader indices and the average stocks performance within the S&P 500 have been so much weaker than the very concentrated market cap-weighted S&P 500 index this year. From a technical perspective, the underlying performance breadth remains weak, while several broader and equal-weighted indices remain flat on the year with elevated volatility. A challenging risk-reward setup in the context of 5% plus risk-free yields that are currently available in money markets and T-bills. Yet the number one question we continue to get is whether there will be a rally into year-end. For equity-only asset managers, that's an important question and debate. But for asset owners and allocators, the prospect of adding additional equity risk at current levels seems unattractive given these other alternatives. The bottom line, we think the strong rally in rates drove stocks higher last week. Bulls have interpreted this move as a signal the Fed is done hiking rates and is likely to cut next year without any material deterioration to the labor market or some other negative event for growth. In contrast, we believe that the rate decline was mainly a function of less than expected longer-dated bond issuance guidance from the Treasury, combined with some signs that the economy is slowing from the torrid pace of the third quarter. This is in line with our economists' tepid forecast for the fourth quarter and 2024 GDP growth and supports our view that the earnings recession is not yet over. Such an outcome suggests last week's rally should fizzle out over the coming week or two as it becomes clear the growth picture does not support either Fed cuts or a significant acceleration in EPS growth in the near term. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.